For U.S. and is often discussed, it is important that it actually be delivered. Through the suite of resolved global mandates offered at varying risk levels, we aim to strike the balance between global...
This is what happens, ladies and gentlemen, in a live show when your head of marketing is not around. Let's try this take 2, shall we?
Yeah, let's do it.
If the man can find it.
And the right commercial.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.
Oh yeah.
All right.
Did we just
Nice.
end the broadcast?
Was she on double speed there? Like I feel like my heart.
Yeah,
rate
because
just
otherwise
try
it
to put
ended
her
up being a
on triple
4-minute commercial. So we got a robot doing it. Of course, I got the wrong commercial there as well, but that's okay. You know, this is the magic of live broadcasting. This is what brings the
You're
people to the
absolutely
show.
killing it. Exactly.
Today, ladies and gentlemen, welcome Rob. I'm gonna try this. Okay, Rob Van Wielingen.
Perfect. Wielingen.
Okay, one of those two was right.
Yeah.
Rob, thanks for joining us today, fellow Canadian, which is a rare thing in this podcast. The Canadians are starting to come up to speed with all these concepts that we've been talking about for over a decade now. But Rob, why don't we start with your background? Tell a little bit about your firm, Viewpoint.
And before we
Hold on a
do,
second.
don't jump the gun there.
We got to do the.
Yeah.
We could do it
Who's
afterwards.
going to
All
do
right.
it? Richard, do you want to do
Who
it?
wants to do it? Richard, go ahead.
Another ad? Is there another ad coming or?
No, we just want to let everyone know that everything we talk about today should not be construed as investment advice. You know, it's 4 guys hanging out on a Friday afternoon live on YouTube. So this is for entertainment and information purposes only.
Well,
with
so
that-
what are we drinking
That's
tonight?
right.
What are we drinking? Rob, what are you having?
I have a really high class peach neutral.
Oh,
Oh
you
my
like
I don't know if you guys. I don't know if. Yeah, it's kind of like a White Claw, but a little bit different. Yeah.
Is that a Canadian drink? I've never seen neutral.
Yeah, it
before.
is.
Must be.
Yeah, it is.
It's yummy, actually. It's low carb and stuff, too, I think. I'm drinking a nice Chianti. No fava beans, but...
I got my freestyle, my Canadian freestyle here. You know,
Good man.
again, low carb, low alcohol.
That's right.
Trying to
I
keep
don't-
it clean.
I don't have much going for me.
You
I
drink a
have
straight vodka over there, Richard?
let's call it straight vodka. I have high hopes for the afternoon to actually get out and do some sports. So I'm keeping it clean today, boys.
Oh yeah, you're playing soccer with the Latin Americans, right? With the other
that's on
Spanish-speaking Latin Americans.
Yeah, that's on Sunday, hopefully, if the rain allows for it. But yeah, looking forward to that.
I'm getting in a car and driving for 3 hours after this with my kids, so I'm just gonna have one probably.
A little cottage action.
Good.
Yeah.
A classic Canadian move.
Oh, yeah,
in
it's-
the
Yeah.
summertime.
It's
Well,
a
we
long
call them
weekend, right?
cabins. Yeah, it's long weekend.
right.
Out west, we call it a cabin, not a cottage. Yeah.
Where are you based out of, Rob?
Calgary.
Nice.
We call them cabins in Newfoundland, too, where I'm from. It's just the, Ontario, Quebec, and BC that call them cottages.
If you want, I
Summer
got that.
homes and every other pretentious.
BC
I got
is
that
cabins
from the
too.
Pentabret. Have you guys seen Mike Myers' latest on Netflix?
No.
Where Rob Scarborough, the protagonist, Rob Scarborough, he's from Scarborough. It just, he goes and does every possible Canadian mannerism in 6 episodes. It's a classic Mike Myers show, worth a watch, I think. It's not as good as some of his other stuff, but it is, as a Canadian, you'll enjoy it.
Well, the
Highly
3 people
recommend
that download this that are Canadian will really enjoy this Canadiana.
Well, no, we got to educate the world, man. We're spreading the love, spreading the love.
Have you guys seen Letterkenny?
I haven't
No?
watched it.
Oh, you got to watch that one. Yeah.
Okay, that's also on Netflix, right?
Yeah, I don't know what it's on, but it's just small town Canada, hockey players and farmers, and it's ridiculous, but
Okay.
similar
All
kind
right,
of thing.
well.
Yeah, so I'll just jump in.
Yeah.
So my background is in well, let me take a quick step back. Our family history is in the energy business, in the oil and gas business, not real estate. But my background is not in energy. My background's in conventional portfolio management and some tech. So after university, I was bumping around the kind of tech scene in Vancouver, Western Canada, and I just love finance and I love markets and portfolio management, and came back to Calgary. And it's a bit of a unique story because as a G2 in a family office, many families want G2s to go out and cut their teeth before joining the family office of the family business. And I was doing my CFA, and my dad, he was just like, well, why don't you just spend a summer as an analyst at the family office, get to know the business a little bit. You're doing your CFA, and I never left. So it's been 12 years now, and it worked so well, working with my dad, and then now growing into a portfolio management firm. I've just been there the whole time, and you don't see that too often in the family, ultra high net worth family office space. But initially, we had a portfolio that would make all of us multi-asset diversification quant guys puke. Like, 95% energy, 95%.
Invest in what you know, right?
Canadian energy, Canadian junior private energy.
Wow.
So not all of it was private, but so we embarked on a plan to diversify our portfolio and create a more institutional quality investment program. And the other thing I would just note is at the same time, Mac, so my dad, his name is Mac, he was one of the founding directors of AIMCO, and subsequently the chair of AIMCO. And so he was having that experience, overseeing $100 billion and going back to our family office and saying, well, we need to, buck up here and create a more institutional quality portfolio for ourselves. And then due to my interest and background in technology, I don't have any background in data science, but my interest in data science, we just started managing our capital in-house increasingly over time in public markets as we got liquidity from energy and private equity. And in 2016, we registered in Canada, as you know, but for your listeners who aren't in Canada, we don't have the RIA system, but we registered as a PM and started taking on external capital just from other family offices around Alberta to manage in what was initially very rudimentary Excel-based models, and now has grown significantly into a full-on quant operation. Maybe I'll just stop there because I'll keep talking.
So no, that's good. But let's take a step back for a second, because I think you are probably one of a small, honestly, in Canada, you're probably the first family office that attacks a problem from the perspective of creating an all-weather type approach that is systematic in nature. And it's interesting. The origins are the classic family office that I see in Canada, which is highly concentrated in the thing that the family did. Or real estate tends to be also pretty important. And trying to get people off that is nearly impossible. And so tell us how you got there, first of all, how you went from you personally seeing that portfolio, doing your CFA, thinking about portfolio, because the CFA doesn't teach you about proper portfolio construction. So how did you first get it, and then how did you accomplish the transition? I imagine your father had some to do with that in Aimco, but tell us a little bit about that.
Yeah, there was no convincing. My dad and I have a real special relationship, and it goes back a little bit to even his father, who is an oil and gas entrepreneur as well. And he used to tell me, Rob, his name was Gus. He used to tell me, Rob, I know what it's like to be rich. I've been rich 3 times. Meaning he was an entrepreneur.
He's been poor 3 other times.
Yeah. And so he never employed those kind of principles that it takes to properly steward significant private capital that is so hard to build. After tax, private capital is so hard to build. And so Mac took the opposite approach, even in his operating businesses and in his investment companies. It was always risk management. And so it really came from him and from both of us. But we want to steward this properly for our family, but for society. That was kind of the genesis of it. So we committed to a program where we just, no matter what the markets were doing, no matter what oil and gas was doing, no matter what markets were doing, every year we'd peel off a certain percentage out of energy and into broad markets. And initially we were allocating to other managers, and for a long list of reasons, just got frustrated with the conventional stock picking, narrative-based approach, and that was kind of the birth of the Quant philosophy.
What year was that, just out of curiosity?
I would say back during I remember specifically like the taper tantrum 2013, I would say, where we'd spent 4 years or so, we've gone through the financial crisis, spent 4 years with this goal of diversification, and then subsequently around that time we started thinking more about internal management and the Quant. But it wasn't until a number of years later that we had enough confidence and sophistication to actually take the plunge.
And this began when you guys were still a single family office, and you guys opened up to become a multifamily office once you had the framework somewhat established.
Yeah, we're not a multifamily office. But yes. So that was when we were a single family office, just managing our own capital. And the reason that I say that is that we only offer our investment management process to third party investors. We got enough problems with our own family. We don't need to offer out estate planning and philanthropy and personal services to
private jet
others.
concierge programs.
No.
You don't do any of that? Damn it. You almost had my money.
Yeah.
Right. Okay. So you get into diversification, but did you get into risk parity right away was it risk parity, or was it just broad management? Was it tactical asset allocation first and then risk parity? How did you come about that?
So I always have, from going way back, I always loved the concept of risk parity and return stacking, as Hofstein would call it. Now
Hofstein?
We call it, yeah. Or you guys?
Hofstein and Gordillo, my friend.
Both of you.
That's shame.
Whatever. You're all just kind of this herd on FinTwit.
He's stealing. He's just, all right. He deserves it. He's been talking about it more than you.
Very triggered. Rodrigo
good.
came up with a name, so now you've just really aggravated.
Oh, perfect. Now we can get into it.
Exactly.
And so, but it's much more complex, and so Mac. So our first strategy was tactical asset allocation, or as you'd call it, adaptive asset allocation. That was our first strategy, and then risk parity. We launched a couple of years later. But it's really that risk optimization engine we've built. We now apply it to obviously our risk parity strategy, but also to our commodity strategy and our multi-asset Asia strategy. So and then GTAA kind of sits on the side with a separate set of trend and momentum and a separate set of algorithms. But it's really that risk optimization engine that's the core of our strategies now.
I'm still curious about, I want to dig a little deeper into the transition from concentrated private market energy oriented portfolio to diversified multi-asset, because this really has been, over the entire duration of all of our careers, I think, one of the most interesting psychological challenges, which is the path to getting rich is literally the opposite of the path to staying rich, right? The only way really to get very wealthy is by taking one or more very concentrated bets that happen to pay off, right? Whereas the only way to stay wealthy is to diversify your portfolio against all of the risks that might cause wealth to deteriorate either in nominal terms or in real terms over the long term, right? And so many investors who got rich by investing all of their money and resources and time in a business that paid off think that the way to sort of stay rich is to continue to invest in private businesses, and typically private businesses in their community or in their province or their country, et cetera, through private equity type deals. So I want to dig into more of the thought process that allowed you in your family to kind of make that leap. I mean, I always say nobody goes to God on prom night, right? So it's typically crisis necessitates change, right? So a really, really negative, bad, scary experience precipitates some kind of rethinking and a shift in direction. Is there anything you could point to, or is that just way off the mark for you and your family?
Well, I think it was the financial crisis. And then Mac, like Aimco was formed just before the financial crisis and into the teeth of the financial crisis. And so Mac went through that and came out of it thinking, holy hell, like we need to start thinking more serious. I think that was the kind of the come to Jesus moment.
Yep.
And I mean, you hit the nail on the head early on in our internal investment committee meetings. We had a quote like, the skills required to steward capital are the complete opposite of the skills required to build capital. Like, we had that, and we still talk about that with our investors, and it's true. It's very much true, and that's why you see so many blowups, and particularly in our neck of the woods. For anyone listening who doesn't know what Calgary is or Alberta, we're all energy here. It's all energy all the time. It has been. Now it's changing in tech ecosystem, and the philosophy here is always very entrepreneurial, which is fantastic. But even when energy markets started collapsing in 2014, we would we'd have a meeting with a family, and they would say, well, we can't sell here because we're at the bottom right, the bottom right of this chart, and we own $100 million of this company. We can't sell here. And then it would go a little bit further. Well, we can't sell here. And then it would go a little bit further. Oh, we can't sell here. And that's like that bias, right? You look at that chart being framed, and you're in the bottom right-hand corner of the chart, and you think, oh, I can't sell at the lows. And your brain just frames it that way. And then when times are good, you don't want to diversify because they're so good, you're making so much money.
But you don't want to diversify out of things that have been treating you so well.
Yeah, why would I diversify with worsify my portfolio with shitty returns?
my best
like
line there
had a bit of a vision there when he was half tongue in cheek alluding to the fact that he had made a fortune 3 times and then lost it, I guess 2, because he kept the third one. But so I guess he had some of the understanding that concentrated risk makes and breaks the bank. And so did that help in sort of getting the family on board with the idea that diversification was the way forward to stewarding the generational wealth side of things?
Not through Gus. So bless his heart, he actually ended his life with very, very little. And so he never really learned that lesson, but Mac sure learned it through that experience with
Watching his dad,
yeah.
I guess, make and break.
Yeah. Yeah.
Yeah, it's amazing with regards to the behavioral bias. It's my whole career. It's been the same. You know, let me watch what you're doing, and when we start seeing, I want to see how it does in a bear market, and then I'll decide. And my answer was always, so let me get this straight. You need to lose money in order to start making money. Like, that's how you're going to do this. It doesn't matter. You're going to see 3 months of downturn, and that's going to be the decision. None of the actual live performance or back test is enough for you to make a decision today. You actually need to feel the loss before you capitulate.
And then,
the
of course,
answer is always
down.
Yeah. But then they're down and they don't do anything.
Yeah.
And
Yeah.
it does. Watching the price is not enough. You really have to take the red pill over time and years of education, right?
Well, and it's just human. Like, it's no one's fault. It's just, honestly, it's just we're kind of idiots at making decisions. Like, I actually kind of believe that. You know, we're really poor decision makers. I think. In a lot of cases, especially when it comes to emotional. I mean, that maybe is obvious in the behavioral finance theory and all that, but it's just it's the human brain, right?
Yeah.
So I think a lot of
yeah.
oh yeah, okay. I was gonna say, so I think a lot of people have started on this same journey. I mean, we went on this journey starting. You know, well, Rod sort of was on a bit more of a systematic trend journey in the '08 crisis to the benefit of his clients, and Mike and I more sort of came to Jesus, so to speak, after the GFC as well, in terms of wanting to approach markets systematically and systematic decision making and multi-asset diversification, et cetera. But I want to know where you said you sort of started with global tactical. So what was the journey there? What was sort of what were some of the seminal pieces that you read? What did you start with exactly? And then what motivated your thinking to evolve?
So it all started with the conversation about active versus passive, which is a total misnomer. But that's where the conversation started with Mac and I, and we'd go to these conferences and talk to people about it, active versus passive. What does active mean? What does passive mean? And basically came to the conclusion that there really is no true passive because you're making active allocation bets. And whether you're using a stock picking approach or an index is actually significantly less consequential than your allocation. This isn't really news.
Your asset allocation.
People.
So your mix of stocks and bonds and your regional allocations, right? Yeah.
Yeah. And so we created this concept that we called global beta, or the global investable market portfolio, which I know Neb Faber has talked about. And there's that seminal paper by a fellow Dutch guy. I can't remember his name, but yeah. And so we studied that. That became kind of our Bible in terms of thinking about the world of financial markets and how to look at our portfolio. And so Matt kept saying to me, Rob, let's just, dust all these fund managers and all this complexity and just own global beta. And that was a very attractive proposition because, over 5-year periods, it's never posted a negative return going back to 1900. So we took that paper and we did a whole bunch of work on it, that concept. But there, at the time, I would look at that portfolio and think, well, this portfolio and the concept is great, but it has way too much fixed income in it. And rates have to rise, right? And that was what, like 2014 or something like that.
Yeah.
So regardless of what happened in that world and where we are now, that was kind of the genesis of, okay, we have global beta. We like global beta. As a private family investor, the risk return characteristics of that portfolio and in particular the huge slug of fixed income in there actually may represent a bigger risk than we think. And so we started building rules around it. And that's where essentially where trend and momentum, I started opening this whole world into trend and momentum in CTA, as well as what we call carry or cross asset valuation, being the equity risk premium. And as stocks start looking more expensive or less expensive relative to bonds and rates, is there something there similar to a value factor, but based on the equity risk premium? So I started building rules around that, and that's really that was the seed that started that strategy.
So you went, you had this opinion of fixed income at the time. Then the way to get away with sinning a little, as Cliff would say, is to allow you to have bonds as long as it didn't, it didn't go below a certain moving average or whatever. But I imagine that's how you allocate it between bonds and equities. So it's bonds, equities as a global market portfolio. When did the commodity side come in? Like, when did you start thinking about inflation risk in that portfolio?
So we really started looking at commodities at the same time as risk parity, so probably about 2018. And commodities they've been in the dump for so long, but we still really love them. In particular, the more esoteric stuff, livestock, grains, softs. Like, we have oil and gas up to our gills. And so introducing and just seeing the effect that adding commodities has on a portfolio is really powerful. And so we started incorporating commods into our strategies around that time. And in regards to inflation, like, no one knew what was coming out of COVID, but leading up to COVID, it was rates have to rise, rates have to rise, rates have to rise. And we were in this deflationary kind of cycle since the financial crisis. And they just never would rise, never would rise, never would rise, obviously. And then finally, that was just the spark. And so we've been writing and talking about inflation for about 2 years and the potential for inflation. And we launched our commodities strategy just shortly thereafter, which is just a carve out of our risk optimized commodity bucket within risk parity. So we kind of put our money where I'm not taking a victory lap here. Like, we had, no one knows what's going to happen in markets and economics, but certainly it was a growing risk, and it's turned out really well. So, I mean,
so far, yeah,
bit of a cap. Turned out really well for that strategy. There's a lot of other things going on, but yeah.
Right. So let's get into. So one thing is the framework, right? Understanding, going from your passive to your global, to tactical, adding commodities and futures and all that fun stuff. But you do have a pretty robust quant team under the hood. How let's get into the nitty gritty here. Like, you can put a risk parity portfolio together like in Tony Robbins' book by Ray Dalio, or you could do it in a much more thoughtful approach. So I know you guys are big into like thoughtful optimization on asset classes. What have you guys put together there, and how do you think about that problem?
Our two key research and data science guys have been around for almost that full 6-year period. And when we went to start researching risk parity, they devoured everything out there on it and identified a number of problems with the existing optimizations out there, whether it's CCD or a naive inverse vol approach, or any of the 3 or 4 main kind of HRP, and built a matrix of what are the problems with each one of these, what are the potential risks that we're missing in these models, and created our own out of what we think were the best pieces of each of those models. And so we call it recursive risk parity. So we're running it at multiple levels through our portfolios. And we've introduced things in there that we think address the problems of the instability of covariance matrices when you have get over a certain number of asset classes and a whole bunch of different things like that. How to address FX was a big one because it truly is global. And we've ended up with this. We don't even call it, looking back, I almost wish we'd named it something a little bit different, because what we're really doing is risk budgeting and risk optimization. It's not always risk parity per se.
Can you say a bit more about that? So kind of feels like it is risk parity, like from just hearing you.
Well, parity
like thing, why would it
meaning
be different?
Parity meaning equal, obviously. But in some cases, we're not actually, like, as we go down into the more granular parts of our model, we're not actually allocating equal risk contribution in every case. Like sometimes we're allocating 70% risk contribution between these two commodity buckets or between these two commodity contracts for a whole variety of reasons. So we have the ability to budget and allocate that risk, and it doesn't necessarily have to be equal risk. That's kind of
tactical tilts that are overlaid atop a neutral, more equal risk contribution. Is that?
Yeah, but it's not based. The tactical tilts aren't based on an outlook or anything like that. It's more like, okay, because Natty is so volatile, we would have none of it in the portfolio. So we want to on an equal risk basis. So we're actually going to allocate more risk to Natty just because we do want to own some of it. It's more like around kind of corner cases like that, but our model allows us to do that.
And it's all systematic in nature. So there's no, you guys aren't making any discretionary calls within. I guess the discretion comes in the building of those systems.
Yes. Yeah, and like clustering, there's some discretion. Like we have a human clustering and then a machine clustering program as well.
Can you talk more about those two things? That sounds like something that we would want to dig a little deeper into.
Yeah, so when we're defining our asset classes, or we call them clusters. So if you're looking at international fixed income, North American fixed income, international equity, North American equity, commodities, inflation-linked bonds. So kind of the 6 or 7 high-level clusters, and I've just clustered them by saying that. And so, but the reality is, with regime changes, Japanese JGBs can look really similar to treasuries over a certain kind of market in a certain period, and we actually want those clustered together for a risk budgeting exercise, but we can't see that. And so that's where we actually do use machine learning, is in that machine clustering algorithm. And ultimately the goal is to create a more precise model.
That does away with labels and just understands it from the recent data that it's looking at. Yeah, that's.
How are you determining if it's more precise? Like what objective are you trying to achieve?
Yeah, I mean, ultimately it's achieving our volatility goal. So we're targeting 15%. But it's a really good question. I don't really know. I'm sure if Ben was here, he'd spout off about that. It's something we look at. I'm just not exactly sure how, other than, wanting to take those equal bet sizes consistently, no matter what the kind of market environment is.
Right. Yeah, that's more for the deep quants in the team, I'm sure.
Yeah, no, we've I remember back when we were doing a lot more of the risk budgeting stuff, there's merit to the idea of wanting to, for example, you want to have your fixed income bucket represent 10% fall. So you're going to target 10% fall for the fixed income bucket. You're going to target 10% fall for the commodity bucket and 10% fall for the equity bucket. Mm-hmm. And then once you target those, now you've got your individual market weights, you've got your sector weights. Let's say we're going to sector by asset class. And then, so once you've done that, then you can lever the the full portfolio to
Yeah.
hit whatever your vol target is, and there was some merit to that type of method.
Yep.
So let's move away from the quant side. Do you guys ever see the world from the good old-fashioned fundamental macro perspective and make some decisions there?
We've built probably, I don't know, 10 different macro models and dusted every single one of them.
Can you give us an example?
Yeah, so back in the early days when we were talking a lot about country rotation and country allocation. We had these great ideas of building macro models for each financial market ecosystem that will help with regime detection. Like, what kind of economic cycle are we in Japan right now? What kind of economic cycle are we here? And I had these grand ideas of creating a business cycle chart for each market, and being able to tactically adjust based on where we are in the business cycle. And excuse me. And so we would look at all the conventional macro metrics, employment markets, all this super lagged, infrequent data, trying to determine where we are in a given economic cycle. And nothing worked.
Yeah, like reading tea leaves.
Nothing, and there isn't enough data points. It's all these funky lags. All this data actually came out at 3 because they were an hour late, and then that gave us a look ahead bias, and nothing worked. And so it's something that's on our long-term list to revisit, but it's just not a priority because it just doesn't seem like a suitable application for our types of models, including AI. Okay, so we know we have AI expertise on our team, and so we've built AI models, and we could go out and market that, but we don't, because it's too chaotic for these types of true AI. Like, we use advanced statistical methods for certain parts of our model, but it's just too chaotic and too unpredictable for true AI in this kind of macro space and portfolio construction space. Like, maybe there's applications of AI if you're trying to arb, micro tick structure in a yield curve, or trading 20,000 times a day. But in our applications, we haven't found anything where true AI works or adds value in any way.
Yeah, it's not
to your
closed
point,
circuit chess game.
No,
it's a great buzzword. It's a great buzzword. And it sells, and people love to hear that you have some AI or some machine learning. But I'm wondering if you're able to express some of the views that you guys have tried to model out in your global macro system that have been dusted off over time through some of these other models effectively. So you can express some views in currencies through carry or so on and so forth. So have you found some overlap in some of the views that you wanted in global macro through these other quant models?
Not really. I mean, we do some carry type stuff, but it's not really to do with macro views. It's more to do with the shape of the commodity curve, or you could kind of extend that out to macro a little bit, but the short answer really is no. You guys? You're saying that oh, we have the answer key here.
No, we don't use any low frequency data sets at the moment, right? So anything in the monthly time range, for sure, though. I did note that AQR has updated their macro momentum paper, which is of passing interest. I don't think it would be anywhere near the top of our research list, but I don't know. Seems there's something interesting there, I guess. So aside from sort of risk parity and the core diversified risk premium allocation, what other sleeves have you guys investigated and built, and where are you currently focused on building out some more sleeves?
Well, When you say sleeves, like, we're attacking multi-asset Asia now, but it's using a similar kind of risk optimization approach, just in markets that are much more difficult to access and underrepresented in investor portfolios. So that would be our latest application. And then we also, with commodities, we just felt that the options for commodities were so limited in terms of thoughtful products on the market. So we carved that out as well. But that's really where we're at. Where we're really at now is trying to, like, research has gotten way ahead of all the other parts of the organization. I'd be interested to hear your guys' views on this, actually, with your own business. But so we built out a client service team, and they're like, well, we need to focus on client service. Like, research is way out there, and the other parts of the organization need to catch up. So we're really focused on building out tools to increase investor transparency, some more different kinds of tools for investors to be able to do analytics on their portfolios, their comprehensive portfolios, not just what they have with us. We're going through a marketing and branding rebuild. I don't know if you've looked at our website, but you probably didn't know who we were till Rod and I kind of stumbled into each other. And so we're kind of taking a step back from that and going back to a number of research projects that have been just sitting there waiting and need attention, that we call the boneyard. All the ideas that have been dusted, now we have more sophisticated tools, and we're gonna bring a lot of those back up from the dead and take a look at them with fresh eyes.
I guess following up on Adam's question, you've largely explained some of the global beta approaches that you guys have taken. You've alluded to trend and momentum. You've also mentioned carry. What are some of the other, whether you want to call them sleeves or tactical tilts or nudges, what outside of the risk managed global core are you guys investing in your core strategies?
Tail. We don't really have a tail risk strategy in place. And somewhere, if Scott's watching this, he's just chuckling because I've kept saying it's not a priority, it's not a priority, and then all of a sudden it is.
There's that human nature again.
Yeah. So taking a really hard look at tail, we recently hired a data scientist who's got expertise in volatility trading and experience in vol trading. So kind of taking a look at some of that type of stuff has become much more of a priority. Yeah.
What about on the trend and carry side? You did mention those earlier, so I'm just wondering, are those things that you're actively deployed to?
Yeah.
And if so, how? And how have you thought about those?
Yeah. So it depends. So there's a few different kind of iterations of carry that we look at. One of them is based on the concept that we need to get paid to take risk in financial markets. So as we move from risk-free rates out into equity markets and credit markets, and as those premiums are changing, we're buying cheaper asset classes basically, and we see the same relationship there that we do with broad market valuations and long-term future returns, just in isolation. So that's what we call carry in our global tactical strategy.
How do you deploy it? Like, what are the mechanics?
So as equity markets start looking more, the simplest example is as credit spreads widen, we start buying credit. So it's the opposite of trend and momentum. And so, if credit spreads start blowing out, we'll start legging into credit over time because you're getting paid more to take that risk. As credit spreads go to zero, like they are negative, like they are in parts of Europe, we don't own any credit, just from that one set of algorithms from our carry algorithms. So that's kind of how we're implementing that piece. And then trend and momentum would be very, very similar to all the stuff you guys put out on ensembles and we have ensemble approach with everything we're doing, including our look back periods within our risk budgeting stuff, and big fans of that approach. The one area would be that's been a challenge for us that we're looking at again would be trend and momentum within fixed income, and as it relates to the yield curve.
Like, so long 2s against 5s, long 5s against 10s,
Yeah.
that kind of stuff.
Yeah.
Right.
Yeah.
So sorry, from an integration perspective, like, are you separating let's talk about your family office, right? Are these all separate parts, or are you combining them into a single thing where you have a trade plotter that combines them beforehand and then spits them out?
Well, we have 4 pools, and so each of those pools has its own model, totally separate from the family office. But our family is in the pools directly alongside all of our investors.
Right.
Not sure
okay. So you're in all of those pools. So I'm just trying to think from a portfolio construction perspective.
Yeah.
You have those 4 pools. Your family invests in all those 4 pools, and you have your risk parity. I'm trying to disaggregate is whether you've kept the GTAA approach, or you have your risk parity, and then you have your long short CTA, and then you have your carry, and then you have your commodity. And
I see what you're saying.
Yeah.
Yeah, they're very much contained within the pools. And so based on what we want in that particular pool, all of those strategies, like we don't have what I just described in terms of carry, that's only in our GTAA strategy. We don't run that in risk parity or commodities or anything like that.
So what are the 4 strategies? Because I think you've hinted at them. I'm trying to get a sort of bird's eye view of what the 4 pools are and what are the different rules that are guiding each one of the 4 pools.
So our core asset allocation fund, which would be similar to your adaptive asset allocation, and that uses trend, momentum, and carry. Our global risk parity strategy, which is entirely based on volatility scaling in our risk budgeting engine, risk optimization engine. Commodities. So we have a commodities fund. That's basically a carve out of the commodity component of our risk parity pool in terms of the actual strategy that we're using to run it. And then multi-asset Asia, which is based on risk optimization, but focused on Asia ex Japan.
Okay, so let's kind of shift gears a little bit and talk a bit about the family office dilemma. And one of the key things that I hear from family offices all the time is tax. That's number one, and then we'll figure out the investment decision second.
Yeah.
Being active, generally speaking, is not conducive to a tax efficient strategy. So how do you deal with that, and how do you mitigate it, if at all?
Well, we're going to move in with you guys.
Are you really?
Yeah, we're coming down.
Amen, brother. Let's do it. That's awesome. Here, you can drink the Caymanian booze just with us.
We have tax loss harvesting. Risk parity is not that efficient from a tax perspective. We do what we can. But we are looking at offshoring strategies. That's basically the only answer I have from the tax perspective. But on the topic of family office, trends in family office investing, I did want to make a couple comments on that in general, where we're still seeing this trend of moving towards an endowment model. And I described it, in the context of our own family too. We want to create a more institutional quality portfolio. And we're still seeing the trend of, and you mentioned it, Rod, I think at the beginning as well, buying private businesses, direct investing, venture, angel, real estate, infrastructure, all these privates that are being on offer, and just the explosion of offerings in the private space. And we're increasingly seeing families, that tidal wave is still in effect.
Still happening. So you still see that growing.
still happening. Even though that Swenson's model is how many years old now? 30 or 40 years old. And valuations, I mean, I have my own personal views, like valuations in those spaces are just as high or higher than public markets.
They're
But
astounding. Yeah.
what I was going to say is, and there has been a lot of innovation in those areas, but there's been very, very little innovation in the public space. Very little. And it would surprise, and you guys probably have experienced this, but how many large family offices are actually running their portfolios off the side of their desk? Like, we see deals. We see deals all the time. So we're seeing deals. They're coming in. We're looking at this deal. Oh, this one looks good. Let's do some more work on this one. Oh, I don't really know that guy. Put that one to the side. So there's just deals coming in and in and in, and which is great and it's fun.
That's what I was going to say. You're in with the other in the family office secret society guild, right?
Right.
So you want to be part of that crowd.
It's fun, and Matt calls it the X factor, where it's not fun just sitting in global beta. That's not fun, right? And we've created these single family offices that are supposed to be a level above all that, right? So there's a ton of bias in there, but that was part of, the dissonance as well when we started diversifying our portfolio was, how are we making decisions? And I know like a lot of family offices, and it's this, we all face the same. How are we making these decisions? We're just going on a deal by deal basis, and we like this deal. Okay, so we're going to sell a bunch of these shares in public markets to fund it. Okay, we did that. So it's always surprised me that with the sophistication of the market, how decisions are made. And so we created, all kinds of frameworks, and we have what we call our stewardship pyramid, where the bottom of the pyramid is global beta, and then you go up and you add risk parity, or you add some other liquid alt, and so you tactically tilt. Maybe you think inflation is coming, so on top of global beta, you have a slug of commodities, and then on top of that, you have your entrepreneurial investing, and so and then you make targets at each one of those levels, and so it's overarching. How much you have in U.S. stocks, how much you have in U.S. like our models are doing all of that work at the base of the pyramid. And as you go up the pyramid, illiquidity and complexity and cost goes up. But that's kind of in the background as well. Is there's been a lot of innovation in private markets and very, very, very little in public markets. I mean, aside from now, everyone has an ETF portfolio, which is fantastic. But that's probably the biggest innovation that I've seen in the last 15 years, like in that space.
Which still baffles me as to what the major benefit of having something you can trade intraday as a long-term holder of asset classes. The only innovation is that somehow we've convinced the public that an ETF should be lower cost than a mutual fund. That's fine.
Yeah.
But in terms of innovation itself, it's just silly to me. You could have launched all of the specialty mutual funds as well and reduce the cost. It actually is a much more useful long-term asset allocation mechanism, because you don't have to deal with the with market makers and the like, right? It's not like in the US it's true innovation because you get a tax advantage. In Canada you get none of that. Yep. You just get some illiquidity. So you're right, I don't think there has been innovation. In fact, the ETF that we launched with Horizons is on its own right now. I expect that to change, but it's very rare to see. Even like the liquid alt space is still the same old long short equity, which is more long than short, right? So Canada is way behind the curve on innovation on the public markets, as you say. It's crazy how behind it is. Yeah. And I think this market cycle is gonna change that quite drastically.
Rob, to sort of just hang back on what you were talking about, the entrepreneurial equity, right? Private equity, which back in the day, everybody used to perceive it as having to command something of a discount because of illiquidity, right? That had the liquidity premium, so you had to have that. And over time, it's at least in our conversations, we've seen that a lot of allocators see that as a benefit, because the lack of marking to market on a daily basis, that illiquidity premium actually creates a behavioral benefit for allocators. Is this something that you've observed, and how do you think that has steered allocation more into the private space as opposed to the simplistic public equity space?
I mean, I would agree. I don't think there is an illiquidity premium anymore. I don't think you're getting that. You're not getting really paid to give up that liquidity anymore. But the benefit is entirely behavioral. I would echo that, and it is a benefit. It is a real benefit that you can't get out of something when it's down, and that you're not looking at the marks every day. And initially, I was kind of dismissed that as like, voodoo, but it is a real behavioral benefit for allocators to not be in public markets.
Well, why don't allocators then allow us to create public market funds that simply mark on a rolling basis, right? Like, that's cool, no problem. We're going to mark our holdings based on the average of the past 3-month marks.
Dude, but you know what? The Canadian,
if it's so beneficial,
like, what do they call it? Whole life policies, right? The portfolios of whole life policies are allowed to smooth their returns over 7 years.
Yeah.
They're public market returns for 7 years, right? So they always have this, like, they've slowly gone from like 8% every year annualized to 8.5 to 7.5 to 6, right?
Yeah.
A slow roll down, but it's crazy how we created this for the right players.
Incentives and outcomes, I think, is what
Exactly.
we're getting at.
Yeah, it's 100% it should be. It's the Meb Faber still trying to figure out a way to lock public assets into a 10-year fund, right? If somebody leaves, there's a massive penalty, and the unit holders get to keep it, right? So there is a disincentive to get out at the wrong time. It's just too many rules with the regulators to allow that right now.
Yeah, we looked at a like a private equity replication model in public markets. Like, we actually went down the road of that, and I'm sure you guys maybe looked at that, and a lot of others have. And I don't even remember why we didn't go through with it, to be honest. But it just wouldn't work in terms of
probably because on a risk-adjusted basis, it looks like shit.
It's a 25% annualized rate of return, volatility.
Compared to the other multi-asset stuff that you're doing.
There is a replicator in the U.S. I think it was Balchunas or Corey that shared it, but there is a replication ETF or mutual fund out there, and it's down 55%, right? Like,
no, of course.
That's what the mark-to-market is telling you right
exactly.
now. That's why you don't hold it. All the benefits that exist right now at 12 times EBITDA is a problem when you're marking to market. The only benefit is that behavioral smoothing, which, again, we have to admit is a benefit for our monkey brains.
So great. Allow managers of public funds to also do it and give their own investors the benefit. If it's so beneficial, why aren't the regulators all over this and saying,
speaking of recursion, I feel like we've done this before.
Incentivize,
By the way, did you guys see Rob Carber's recursion tweets? It was brilliant. Look it up. Look up Rob Carber, look up recursion. It's hilarious.
I did want to circle back with Rob just very quickly on the Asian multi-asset. What are you guys trading in that product, and what's the motivation? Because it sounds like you were drinking from the same philosophical well as we are with regards to being diversified and being global in nature. And so there's a very active bet and an active view in launching an Asian fund. So I wondered if you might just kind of describe some of the markets that you're trading in there, and what your active view from a macro perspective is to allow your brain that much dissonance.
Well, I don't feel any dissonance about it, actually. So we looked at these. So we've got, I don't know, about 20 countries, what we call developed. So that would be, Hong Kong, China, Singapore, South Korea, Taiwan. Can't remember if Taiwan is developed or emerging. India, and then we're in, Vietnam, Malaysia, Indonesia. So these
All
markets,
equity markets, only
no,
equities.
multi-asset. So stocks and bonds. Yeah.
No commodity contracts that are
There's
specific
no
to the Asian
commodities in
markets.
that. No.
Okay.
No. Yeah. And now, obviously, FX is a big component there too. But the reason that we're doing it is because when you look, well, firstly, Asia is significant, emerging Asia is significantly underrepresented in investor portfolios, we feel. So there's that piece. They're difficult to access. The products are typically just long only equity. They're, at least 1%. You have to have boots on the ground if you want to be successful. We get that question all the time. Don't you need to have an office? And we're like, no, like we don't need. We're trading futures, we're trading ETFs, and we're trading FX. But the biggest reason is when you look at those markets, the correlations and the diversification, the internal correlations between those markets are very, very low. And so when you compare that to G7, or even broad emerging and G7, it's ripe for the type of volatility scaling and risk optimization that we do. And so those are the two main factors that drove that decision.
Right.
Interesting.
Well, Rob, I know that you have a big night tonight. Fellow Canadian, the Calgary Flames, I think, is what are you doing tonight?
Kat, before this call, she was like, "Oh man, you look nervous. Like, are you nervous?" I was like, "I'm not nervous for the podcast. It's the game I'm nervous for." Well, we're going up to our cabin, so I'll just be watching on TV. But I've been spending a lot of time at the Saddle Dome, that's for sure.
Yeah, no kidding.
Yeah,
all right, well, we'll let you go to that and start getting ready, start getting real nervous as the game approaches. But thank you for joining us today. A lot of interesting insights. Glad to see Canada or Canadians are moving towards something more thoughtful. We should continue to figure out a way to push these family office closer and closer to optimal portfolios. Maybe we could collaborate in some way. But
yeah, I hope so.
Amen.
Thanks for having me.
Keep up the journey, and we'll have you back again sometime soon.
Sounds good, guys. Thanks a lot.
Thanks for joining us.
Have a great long weekend.
Yeah,
See if
enjoy,
I get
guys.
this one right.
Take
Let's see
care.
if I can get the right commercial this time.
Most investors feel comfortable with their domestic equity and bond portfolios because they tend to thrive during periods of economic growth and low inflation. And we don't blame you. It's been a great ride. But it's a big world out there, full of opportunities you may be ignoring. Sadly, we live in a world dominated by a fear of missing out, or FOMO. And in the last 10 years, U.S. equities and bonds have outperformed and generated massive amounts of FOMO. This hasn't always been the case. In the mid-2000s, the best performing markets were international equities, especially emerging markets, gold and commodities. So what happens if growth collapses and inflation becomes the new norm? Or what if the US dollar collapses and US assets are no longer attractive? What will the new FOMO markets be? And will your portfolio keep up or be left behind? Enter Rational Resolve Adaptive Asset Allocation Fund, ticker RDMIX. A strategy that is designed to thrive across different markets and economic regimes. Unlike most traditional strategies that keep allocations static and let volatility happen, adaptive asset allocation applies a proprietary systematic process designed to dynamically transition toward thriving asset classes and eliminate those that are not, all the while aiming for consistent volatility and stable returns. There's almost always a bull market somewhere in the world. Don't let yesterday's FOMO get in the way of tomorrow's opportunities. Instead, let adaptive asset allocation help you fill in your domestic portfolio gaps. To learn more, visit rationalmf.com and check out the Rational Resolve Adaptive Asset Allocation Fund.